Hey everyone, welcome back to the channel. Today we're going to talk about a topic that's been on a lot of people's minds lately: the recent bankruptcy of Silicon Valley Bank. Now, for a long time, banks have been seen as a safe place to put your money. But have you ever thought about what would happen if your bank actually went bankrupt? Well, unfortunately, we don't have to imagine anymore, because one of America's largest banks just went bankrupt. Silicon Valley Bank, or SVB, was announced in 2022 as the 16th largest bank in the U.S. They reached their highest stock value in late 2021, with shares reaching over $750. This significant rise in value was due to many tech companies pouring money into the bank, adding up to a total of $40 billion in new deposits, making the bank's total deposits a stunning $175 billion. With all this cash, SVB started looking for investments and chose to buy mortgage-backed securities and U.S. Treasury bonds, which are long-term investments that wouldn't bring them any money soon. This was considered a bold move, as the bank was used to investing in quick return-natured investments. However, things didn't go as hoped for the bank. The Federal Reserve raised interest rates due to the current economic situation, causing both the bonds and mortgage-backed securities to drop in value. As a result, SVB's investments went underwater, and they lost $15 billion on paper. This wouldn't have been so bad if the bank didn't have to sell their assets, but since the tech industry was having a rough time, the tech companies needed to liquidate their money. And that's when the problem happened. The bank didn't have the money to provide depositors with, since they had their money put into long-term investments. This pushed them into selling $20 billion worth of assets, resulting in a loss of $1.8 billion. This was marked as the beginning of the Silicon Valley Bank's fall. The bank announced a capital raise of $1.7 billion to compensate for the losses, but the public quickly started paying attention to the possibility that the bank was lacking cash. With this attention came great concerns that led everyone to withdraw their deposits from the bank, and after announcing the capital raise, the bank lost 60% of its stock value in just one day. After one day, the bank was seized by the federal government and put under the FDIC, or the Federal Deposit Insurance Corporation, marking it as the end of one of the biggest banks in the country and the second biggest bankruptcy since 2008. Now, while this story may seem like just bad luck, there was a lot that SVB could have done to prevent the disaster. For example, they didn't have a chief risk officer for 8 executive months. They put all their money in long-term investments without trying to have cash on hand if depositors needed it. And they kept most of what happened away from the people. In fact, they were doing the complete opposite, bragging about being on Forbes' list for the biggest banks in America on Twitter just 5 days before going bankrupt. Make sure to subscribe to the channel for more content like this. And don't forget to leave a like on this video. Thanks for watching, and I'll see you in the next one.